You'll be able to see your slides here. Forward.
Could everyone please come out of the exhibit hall and please take a seat, please, so we can get going?
Stand up behind me. I'm going to leave you up here.
Welcome back. Have a seat, please. Our next speaker, Rick Pederson, is the Senior Vice President, Global Corporate Services of Newmark Grubb Knight Frank. Rick and I have been friends for 25 years. I actually have a rap video loaded, which he told me if I played it today, I would not walk off the stage. So unfortunately, I have to read this extremely exciting resume of his, and I told him I wouldn't roast him. But I will have to tell you that Rick is one of the smartest guys I've ever heard speak in real estate. I personally asked him if he'd come and do this. I'm thrilled he's here. And without a long introduction, please welcome Rick Pederson. Thank you.
Well, thanks, Phil, for that warm and exaggerated welcome. I was just in the men's restroom outside, and someone I know came and said, "God, that Lutnick is something. How are you going to follow him?" And I said, "Well, if you can't be a good example, be a horrible warning." And so this is your half an hour of horrible warning. This illustration that you see behind me is my talk today. It's everything, all the components of what I'm thinking and what I'm going to tell you. And if it's not obvious what's up there, I'm going to proceed to show you a whole bunch of graphs that will explain my thinking. Why graphs? Because I'm deeply moved by statistics, and I'm looking forward to talking about where the economy, I think, is, where it's going, and how it may affect real estate. You will see elements of this picture in this presentation. This is my favorite one. The United States economy isn't going very fast. The engine's on, but we're idling. As Howard said, it's a very, very slow recovery. No one here is surprised about that. but let me talk to you a bit about what I think the reasons for it are. And you really can't talk about the economy without talking about employment and talking about unemployment. This graph is fairly clear about what this recession means. That red line, that current recession line, is our job loss and job recovery post-peak. The blue line is the 2001 recession, and those gray lines are the previous 8 recessions. The point of this is, to no one's surprise here, is this is not a normal recovery. We are still 5.5 years into this. We're still not close to recovering that employment. I think we'll probably get there about 7 years. I would say about Q1 of 2015 we'll probably recover it. Why so long? Well, there are some very important reasons which I think have to do with unemployment, which I'm going to talk about. But I would note that 2001 and 2008 recessions are similar for another reason, is I think that that blue line and that red line are elongated for a very important reason, is it's structural unemployment, or the baby boomers retiring. We have this massive workforce that is now moving out of the workforce, and they're not trained really for the next type of jobs that we're going to be seeing. And so what you see is, in 2001, a lot of those boomers retired. In this particular recovery, a lot of them are retired as well and are not coming back to the workforce. And so as a result, what happens is the labor participation rate comes down, which means that even as you add jobs, it doesn't bring unemployment down nearly as quickly, because that so many people are not participating in the labor markets. That downside of job losses, 60% of that were middle wage jobs between 0, 8, and 10 on the downside. On the upside, it's really been the low wage and the high wage that's recovered. So in other words, what we've had in the last 7 years is we lost the middle wages, and now we've regained the low and the high, but we haven't regained the middle. And one of the key points that I will make today is that we're not going to regain a lot of that middle. It's going to take years of restructuring, retraining new entrants into the workforce to recover that middle wage of employment. Construction, for example, is a part of that. That is one of the reasons why this is taking so long to come back. Businesses are not spending on people. Everybody in this room knows that. They are spending on IP. They're spending on software. They're spending on material handling and automation equipment. They're not yet spending on people, nor are they spending on structures, buildings, as you know. It will come, but it's coming very late in this particular post-recession period. You've got to talk about jobs and the workforce, though, I think, with a different lens. It's different than it used to be. It isn't just a job opens up and you find someone to fill it. Employment is not a simple subject anymore. It doesn't mean that there are no jobs. As a matter of fact, there are 11 million unemployed out there right now, but there are 4 million open job positions. There is a mismatch between what's needed and what's out there. And there are a number of reasons for that, I think. The biggest one, the most obvious one, is what I just mentioned. You've got a structural gap in skills. The new jobs are not necessarily the types of jobs that certainly the baby boom can fill, but not even the millennials, not even the younger ones are trained for that. If you look at the types of occupations that have gone unfilled the longest that are out there right now, number 1, sales reps. Number 2, machine operators. Number 3, nurses. Number 4, truck drivers. Number 5, software developers. Now, machine operators, nurses take special training. Not necessarily sales reps, not necessarily truck drivers. And so it's, yes, we do have a mismatch of skills to job openings, but interestingly, it isn't all technology, engineering, healthcare. It's also at the lower end. Part of the problem with that is we have all in this room encouraged our kids to go to 4-year schools, Harvard, CU, what have you, DU. Not all of them should go there. A lot of them, I think, need to go to a different kind of a school, something that teaches them a job, teaches them to to fit into some of those job openings that are out there that don't require a master's in business or a master's in real estate. And so part of it is, I think, our educational system and how it's equipped to train these people coming into the job force. Part of it right now is technical. Many want full-time, and employers are only offering part-time. Employers are very, very cautious about hiring right now. They continue to be. They have been for 3 years. They will be for the next 2. Each new job is expensive, and so they can afford to be very picky. There are a lot of entrants out there, a lot of applicants out there, and so I'm only going to hire the very best and brightest, or won't hire at all. And so that's another venturi to this. Is it's taking a long time for those job applicants to get in. Something else I've noticed about millennials is they just as soon not wait in a line to apply. They'd rather do it in social media. There are still thousands of companies that don't understand that, and so they're not offering those jobs in the right way. So there's a mismatch, a technical mismatch in that way also. Finally, though, is something that's interesting is, especially in the lower wage jobs, I was in Chicago, a food manufacturing company last week, a friend of mine, who said, we can't find and hire food production workers or material handlers, basic $12 an hour employees. Why is that, John? He says, because they can make more money on government benefits than they can working for my food company. And that's something that I want to talk about as well, is I do think that we've got some structural imbalances right now that mean that salaries, wages in many occupations aren't above the ability to not work and still survive. This is another way to look at it, duration of unemployment. That 1981 to 82 period in the past was the previous peak for the number of weeks that the average worker was unemployed, and that was 20 weeks. Some of you will remember that 81 to 82 recession, probably before this particular Great Recession, the worst economic condition that the United States has had since World War II. That 20 weeks has now been eclipsed by the duration of unemployment. This particular time out is the average is up to 37 weeks. It was up to a bit over 40 weeks. How is that possible? How can you stay out of work that long? Well, part of it, again, is the job market doesn't want my skill set. I don't have the right skills. There's the structural mismatch, but part of it is also there is enough safety net to keep you from having to work out there at this point in time. Part of that is unemployment benefits. We extended the length, we've raised the amounts to some extent, but something I found is once unemployment benefits do expire, you either have to go to my friend in his Chicago food manufacturing company, work for 2 to 3 weeks so that you can get back on the rolls and then leave. That's one way they do it. And so it's short-term employment that requalifies you for unemployment. But what's more interesting and more insidious maybe is disability insurance. Disability insurance, 1% of our workforce in 1970 was on disability insurance. Now 5% is on disability insurance. 5% sounds like a tiny number, 7 million employees. It's a lot easier to get disability insurance now than it was just 10 or 15 years ago because we've broadened the access to it. We've said, for example, the condition can be back pain. The condition can be a mental condition. And so we've broadened that, and it allows me, once my unemployment has ended, to go to disability, and we have a lot of people now on disability. And so this is another reason that labor participation rate is dropping is, frankly, my skills don't match or I don't want to work. I have enough benefits from the government to be able to live, and so therefore we're going through an inflection point, I think, in the economy that says we're not going to see the same labor participation rate, the same number of new jobs being created and filled as we used to 5 years ago, 10 years ago, 15 years ago. I think this is going to take 5 to 10 years to work out. It's a very, very significant inflection point, I think, in the economy. So what about just job growth absolute then? Red line is Denver, blue line is the U.S. Denver, meaning Denver Metro, is now outperforming the United States in terms of total jobs. We're used to being in that position. We came into it late in 2009-10, while the rest of the country was seeing employment declining. Denver Metro held up longer. We matched the United States and now are moving up in the last 2 years at a rate faster than the United States, which is good. And I'll talk about that kind of jobs in a bit, or the kind of jobs that are doing that. People ask me, well, who's doing better than Denver? And who is doing better than Denver? What cities? Houston's one. Dallas, the energy economies are. And that, for the last 2 years, really were the easy go-tos. This energy was where unemployment was the strongest of major cities. But it's changing now. You're starting to see a broader healing in job markets, and you're seeing other categories, professional business services and healthcare and education and construction now growing. And so the other few cities above Denver include Tampa and Minneapolis, and so you're getting a broader healing across the United States. Denver as well, people say, well, you're strong because of energy. Well, yes and no, and I'm about to show you that, but energy is only a tiny part of our job force. It's a nice, convenient label to say that's why Dallas, Houston, and Denver are growing, but in fact, it's really only a very small component of total new absolute net jobs. It really takes the big categories of jobs to move a city. And by the way, before I get off of Colorado, I'd like to mention one thing, is after Denver, what is the next fastest growing city in Colorado? Right now it is Boulder, I heard that. Boulder, but also my favorite town, Greeley. Now Greeley is not an economic power in Colorado, but it does represent something that I think is interesting because you see this throughout the Midwest. Is wholesale trade, which is a fairly boring way to describe non-retail trade. Much of that is made up of agricultural and food kinds of jobs, and that is a high multiplier job cohort. Greeley is seeing that now, so is Wichita and Omaha and some of the other Midwest cities. Denver is seeing a bit of that as well, but I think more and more we're going to be hearing about that particular sector in the economy, more than we have in the past. Something that is important to Denver is and I've seen this, Denver tends to have a lot of self-employed, and that is good news because in the last 5 years, 1099ers, as I call them, self-employed, has represented about 2/3 of every new net job created in the United States. Part of that is because they were forced to. They were fired, laid off, part-time wasn't enough, and so they've created their own jobs. That's great. Part of it, though, is the initiative. Millennials and even baby boomers. Baby boomers are now entrepreneurs, and I think something like 2 in 10 new companies that were formed in the last 5 years were formed by people over 55. And so this 1099 economy is going to be something that's with us as well. It isn't organized as neatly as it used to be so that you in office don't see Hewlett-Packard or DaVita coming in and taking large blocks of space. They're looking at it, they're coming in a different way. They're looking for smaller spaces, more collaborative spaces, maybe working at home, et cetera. And so I think this is the beginning of what will be presented to us as a different way of occupying workspace. That's office, that's also industrial. So self-employed's been important. Small business has also been important to Denver. Small business, Denver has a high quotient of small businesses. But as Howard said a bit ago, that's not been good news because these small businesses need bank loans, and bank loans aren't really yet there. They're tight, very tight credit for small business so far. Something interesting about small business as well is about 70% of small business financing comes from home mortgages and savings. Those two categories haven't been treated well by the Great Recession, so small business is still really lagging in growth here. And so I do think that when small businesses start to see real estate-related growth, whether that's in their homes or it's in the buildings, half of small businesses own their own buildings, you'll start to see more small business growth, which I think will push Denver farther and faster as well. So that's ahead in the next couple of years. Small business, 1099 also good. I'm already talking about this subject. I might as well put the slide on. What is driving Denver? This is industry sectors, and the green is mining and logging construction. This is energy. The purple is professional business services. Yellow, leisure and hospitality. The red is educational and health services. So that's what's been happening in 2013. Those are all very sort of broad, benign categories. Let's talk about them for a minute, however. What is, you know what energy is? Energy has created about 8,000 jobs in Denver Metro in the last 2 years. Even though that great big green line, which is a percentage increase, looks like it is a healthy driver of Denver's economy, it's really not. And frankly, Dallas, Houston, Oklahoma City are much like that as well, is you do have a significant percentage gain in energy, but energy represents only 2% of the total workforce of the United States, about 3% in Denver, and so it really doesn't drive an economy. There is a good multiplier behind it, but what drives an economy are these other ones. Professional and business services, that's 14% of the workforce. What is that? Well, it's law and accounting and engineering and architecture, advertising, et cetera. This is the prime office space driver, and this is really what we want to see. And if you look at the strong growth in the United States, the Minneapolises, the Tampas, the Dallases, it's professional and business services that's really leading it. And that's what we want more of as much as we can get. Then you get leisure and hospitality, which is also important, and then educational and health services. Not necessarily good directly for commercial real estate, but certainly good indirectly because that's where income comes from, retail spending. There are private education, there is private, there's a lot of private leisure and hospitality, and so these are good for Denver. I think that the future of Denver in the next 2 years at least, this chart will look roughly the same. I don't see one sector disappearing, another not there at all. There's a little blue line there, I guess I haven't mentioned that, manufacturing. That's everyone's kind of favorite thing to talk about these days. Manufacturing is actually doing pretty well if you look at it in perspective. When I started in this business, I measured manufacturing in Denver, its impact, well, it's about 17% of the workforce in 1980. Now it's about 9% of the workforce. The good news about manufacturing in the last year and a half, 2 years, is we've been able to stem the decline. So you would get the impression reading the newspaper that manufacturing is this growth industry. Manufacturing isn't, it's just that we've been able to stop the decline at 9%. And it's because not so much they're hiring people, it's really because they're more productive. They have higher margins. And that really is what's saving manufacturing, whatever it is. Denver has a manufacturing component, but it tends to be high-value equipment. Fort Collins has a high-value equipment advanced tech sector as well, as does Boulder. This is quite important to us, but it's a relatively small segment of the economy and the population. So how is government helping? Is government helping? Probably not. Actually, I'm thinking that Mark Twain said, one useless man is a shame, 2 useless men are a law firm, 3 or more useless men are Congress. And the part of the picture that I've drawn out here is the kid, obviously, and note what he's doing. This is, I think, the sum total of the work of Congress in the last year. They really are useless at this point in time in many ways. I mean, I know they're trying to do the right thing, but let me, without talking about the generality of government, talk about the specifics of it, particularly with respect to how it affects business and the economy. One thing I've noticed is I've counted up all of the new business regulations out there. There are 105, since 2009, there are 105 new federal business regulations that each cost business over $100 million. I've only counted the big ones, I haven't counted the small ones. And so there is a lot of pressure being put on by the government, and it's well-intentioned for the most part. This is everything from Graham-Dodd sort of stuff to OSHA stuff. I mean, they're trying to protect future finance, they're trying to protect health and safety, but what they're doing is costing business a great deal, and apparently there isn't a risk return on that action. The Fed is a very interesting place right now. The mandate of the Federal Reserve is really twofold. One, keep interest rates low, inflation low, and number 2, promote growth. Seemingly simple. What they have done, though, is interesting. We'll talk about this. Have they kept a lid on inflation? Yes, they have. Have they kept interest rates low? Yes, they have. They've gotten an A, I would say, on that. That's what QE has done. That's what much of the governmental policy has done, is kept interest rates low. And as Howard said a bit ago, my opinion is they're going to stay low. Yes, you're going to feel a little lift from interest rates coming up in the next year to 2 years, but that's not the Fed speaking. That's just bond yields coming up. There's going to be more risk return required. So you will feel a bit of lift, but the Fed is going to be sitting on rates for the next 2 to 3 years. There's just no ability to move them up at this point in time. So they're doing all right with rates, and I'll talk about that. Second, promoting growth, promoting jobs. How are they doing? Crappy. They're really not doing well with that at all, partly because it's hard to do. Partly it's hard for a government, whether it's City of Denver, State of Colorado, or the federal government, to create jobs. As much as they dither around trying to create incentives to do that, it's difficult for government to do that. And so I don't think that they're going to do that well, and I'll talk a little bit more about that. The third thing that I think that the federal government needs to do is manage the country's business. I don't know what grade to give them on that, but the problem that Howard again talked about is they have kicked the can with respect to debt ceiling, and also with government funding. It sends a horrible message on confidence. It's already taken a couple of points, 1.5 points out of GDP this year. It's going to take some out of next year. It's going to ruin Christmas largely, I think, because consumers are still jittery, and so they're not doing a good job of managing the country's business as well. Inflation. As much as we all seem to want it to be there, and all of my friends say, when is inflation coming? When are interest rates coming up? And I, for 4 years, have been saying they're not coming up. I'm going to say it again, they're not coming up. There's a little bit of a lift there at the end. The Fed's 2% target, we're way under CPI or PPI inflation. There's just no lift. There's no wage rising. There's no demand for products, and so there's no cost pull inflation. And I hear often that foreign bond buyers have lost confidence in us. Well, that's not true. As of a few weeks ago, China and everyone else has been buying enough of our bonds that I think they've reset the May peak. So no one is disinvesting out of the United States. So there's still all of this downward pressure on rates. You've got the market pressure on rates, and then you've also got the Fed's pressure on rates. The Fed is intent on keeping mortgage rates low. And it has helped commercial real estate. It has helped greatly residential real estate. But we're getting to a point of diminishing marginal returns on that, and so we'll talk about that also. Let's talk about mortgage rates. I don't think that they're coming up either. There is a little bit of a lift. Mortgages probably will come up in 2014. We've already seen 80 or 90 basis points now in residential mortgages, although I was fascinated, and you all saw too, that for the first time in history, jumbo rates and conventional rates were the same price. How is that possible? Well, it's not the risk of the matter anymore. It's who's handling them. Banks are doing the jumbo loans. Banks have more flexibility to move those rates down than the agencies. And so it's cheap to still buy a house, even though they've come up. We've still got cheap commercial mortgage rates, and I don't think that they're going to move very far. And when they do, again, it's the bond market speaking. It's not the Fed speaking. The Fed is going to stay at zero, I think, for at least 2 more years. Howard and I do agree on that. Commercial mortgage debt will, by the way, that overhang of commercial mortgage debt that we had in the United States will more or less normalize by 2015, 2016. All of the great fears about CMBS and the bank debt, et cetera, we're moving through that, not quickly, not easily, but it's moving through. And so I don't see another shoe that will drop on the debt markets. We just need to start moving this liquidity through, and I do think we're going to get more and more private lending out there because the rates are high enough to make that profitable. But let's talk a little bit about QE2 and what I think is going to happen. Howard also talked about that as well. You all remember that QE was invented just because the Fed couldn't take its Fed funds rate down below zero by 2009-10. They were out of Schlitz, and so now what do? Okay, we'll start buying our own debt and weighing down the markets on that basis. And it worked, more or less, with respect to mortgage rates. It has kept them down. It has kept interest rates down, and so, again, that's all right. When does tapering start? Well, the Fed says that they're going to start tapering when unemployment gets to 7%. We'll see. First of all, I've already talked a little bit about the fact that unemployment is sticky coming down. It went up a little bit last month, 7.2 to 7.3 in the nation, and that was really more having to do with government unemployment and the shutdown. But I think what's going to happen over the next year or 2 years, as the economy really does catch a gear and get a little bit stronger organically, what's going to happen is that labor participation rate will move up from 66 to 66.5. Infinitesimally strong, other than the fact that that 0.5 equals about 2 million workers. And so what's going to happen is, as you get a real economy, as you get job applicants looking for the jobs that are offered, and you get what looks to be employment, you get more participants in, the unemployment rate flattens out, and so that unemployment rate's not going to go very fast. And so this Fed target of unemployment as the time that you ease monetary policy is flawed from the beginning, because unemployment's not going to move very quickly. But I think the Fed knows this. I think the Fed's not anxious to move those rates up, and so I think that's one reason they're going to stay with unemployment, is it's a nice, easy, memorable way for us to say they're not going to do anything for a while, especially if unemployment stays up. Secondly, there's a lot of thinking out there now that says that even the 7% tapering line and the 6.5% unemployment raise rates line is going to change. And I'll bet you that's the case as well. The so-called Taylor rule is going to be re-examined in the next 6 or 9 months. And if we do move unemployment down more quickly than I think they will, then it will. I do think the Fed's going to come out and say, well, we've rethought this again, and we're going to keep rates lower a little bit, and I know we're going to change our policy. Those rates just aren't going to go anywhere. Will bond markets lift them a bit? Yes. Will the Fed touch them? Absolutely not. They're not going anywhere. One thing I want to talk about, though, before I leave this is growth. Is the government helping with growth? Is the Fed helping with growth? Has quantitative easing helped with growth? And the answer is an unequivocal no. It really hasn't. All it's done is kept interest rates down. We're now starting to get enough data out to be able to see what QE has done on the positive side, and it shows very little. It shows that maybe it has direct impact in creating another 5% of the houses that were built. It has no real effect on industrial production. It hasn't really even helped unemployment very much. As far as I can tell, QE has probably helped bring unemployment down by 0.2%. From 7.8 to 7.6 when it really kicked in QE2. So it's not doing anything to grow, and so my personal opinion is they should end QE as quickly as possible. I know the stock market hates to hear that, and probably some people in here do as well, because there is this sense that if QE is tapered, interest rates go up, cap rates go up, everything goes to hell. It's not going to happen. We just have to get through those sort of understandings that QE goes away, markets know better, there's no more demand, there's no more cost push-up, and nothing changes. Not really. You'll get a little bit of bond market gyration. The stock market will hate it, but we should get out of this business of QE and end it as soon as possible. As a matter of fact, I think we should actually start selling some of those assets back into the market by next year, but there's probably no one in this room that agrees with me on that. So let me talk a little bit about housing, which has been what has brought us up. Out of the recession. It brought the economy down, it's kind of brought us back up, and housing continues to be really the headliner. 2013 was the year of housing, 2014 is going to be the sequel to Year of Housing. I'm hoping 2015 is going to be something else, we'll talk about that. U.S. housing starts, 2 lines here. The red line is single-family starts. This isn't total, this is single-family, and then the blue is what's called NAHB housing market, which is home builder confidence. Home builders tend to be confident, that's fine. And that blue line has now outrun the red line, and the blue line outran the red line. If I had an older chart, I'd show you that it really spiked up too in 94, 95, 96, and it spiked up again in 99. I don't mind that confidence outruns the red as long as the red keeps coming up. We're still not building enough single-family homes. Why not? Well, there's still an overhang of existing homes. There's still distress in the market, not nearly as much. I think distressed sales in the last 12 months have been 12% of total sales. If you look at the prior 12 months, it was 22%, so it's coming down rapidly. So the housing market is pretty much healing itself. But there's still tight mortgage lending on the demand side. First-time buyer economics aren't good in that they're really not, they don't have the savings. or the down payment to do housing. The mortgages are still tight, and so we're not getting the demand, so the home builders are cautious about building too much. We're only building about 500,000 single-family homes in the United States per year right now. We should be building about 1 million, because that's where the household formation rate is. Some of those kids that are living in your basement are starting to move out, and they are looking for homes. Now, that doesn't mean they're going to buy a home in the suburbs, but they are going to move into apartments. They're going to eventually move into homes. I want to talk about that as well. There seems to be this presumption out there that every 24-year-old is going to live perpetually downtown in an apartment. That won't be the case. TD Bank, a Canadian-based bank, did a great study last year and asked a whole bunch of millennials, 24 to 35, what are your housing plans over the next 10 years? 85% of them said, well, we're going to buy a house. I want to get married and have children, and we're going to buy a house. So this idea that it's all urbanization, the suburbs are dead, houses are going to go away, is going to end in about 2 more years. That doesn't mean apartments won't do well. There's still a lot of pent-up demand for that. But this idea that we're moving into a rentership society, it ain't going to cut it. People are going to start buying homes again. As a matter of fact, the average square foot house size, which has been coming down for 5 years, is going to start coming up, especially after about 2015, as you get a baby boom, which I think we're going to start seeing in 2015. Off the track a little bit. We need about 1 million homes right now. We will get to 1 million homes. Millennials will be buying them. Immigrants will buy them again. Immigrants typically buy 40% of the new homes built in the United States. We have had very little immigration in the last 5 years. That's now coming up again. And so we're going to see a new home buyer market reemerging, and that new construction market is going to come up quite nicely. It has in the last 2 years. It's going to come up even faster in the next 2, I believe. There may be a land shortage there, but nonetheless, it will be strong. Existing stock homes, you're selling about 5 million a year of the existing homes out there. That's about 12 or 13% higher than it was last year. Interestingly enough, 1 out of 5 of those purchases are still to investors. Investors are still pushing this existing home market. That's ending, and it will end. I would argue that in most markets, at least, it's probably fairly late to be buying into a home and planning to fix it up and flip it or even rent it, because rents have risen, but not as fast as prices. I don't think that investment in single family is going to be what it was in the last 4 years. Second point I want to make here is building cost increases. I remember my home builder friends in 2011 absolutely panicked, 2012, panicked about last summer's cost increases, lumber and cement and labor. It all just spiked up, and then it came down last winter. And then it came up again in 2013, but not as high. You had this big peak in 12, smaller peak in 13. What's going to happen in 14? There's going to be a smaller peak, but what's happening is that whole supply chain of lumber and labor and materials and hardware is correcting after 5 years of no building. That's now happening, and so we're going to see commodity prices hold. You're going to see labor costs steady, and you're not going to have those surprises anymore. And that's another reason I think that you're going to see very strong single-family home building in 14 and 15. Denver, housing building permit. It looks the same pretty much as the United States. It was high, came down, low for 3 years, and it's come back up. Those blue lines at the end of it are interesting. Some of you might have noticed that there are a fair amount of apartments being constructed. There are a lot of apartments being constructed. We're building more apartments than we are single-family homes right now. Some are worried about that. I'm not. This is just a catch-up that has to do with demand. It has to do with equity availability. This is a trend that by the end of next year will end, and we'll have single-family coming up nicely. The other thing that my friends are worried about is, are we building too many apartments? In my humble opinion, and I tend to be a pessimist, because pessimists are only surprised on the upside, is I don't think so. I think rents are going to continue to grow. I think demand is going to be good. Vacancies will come up. I think we've hit probably a cyclical low in apartment vacancies, and they're going to start moving up, but not enough to squash rents, and so I still think the apartment market is going to be reasonably good. Single-family homes, though, are being built where you'd expect them to. Yes, there are some in Denver County, but you're seeing them in Aurora and Arvada and Castle Rock and Douglas County, all of the fringes. A lot north, you're seeing them in Weld County again. Superior, places that I would have expected to see single-family homes, where land is affordable, et cetera. I'm a little surprised at where we're seeing apartments. Yeah, we're seeing a lot of infill in Denver, Brighton Boulevard, downtown, et cetera, But I'm interested in all of those new apartments that are going up on the Boulder Turnpike, frankly. It's Boulder and, Rushmeyer, you're getting a call. Boulder and Broomfield, there are a lot of apartments up there. We'll see if they're able to hold rents and not overbuild up there first, but that may be the first victim of this apartment overbuild cycle that some see coming. House prices, everyone knows, are good. The red is national, CoreLogic. The blue, I've overlaid Case-Shiller. Everyone knows what Case-Shiller is now. My mother knows what Case-Shiller is now. Case-Shiller, just housing price index. The blue line reminds you that Denver didn't see the house price volatility that the rest of the nation did. The rest of the nation was high, went low, and now has bounced up. Denver went through a boom-bust, but not nearly as strong. But you do see that blue line now below the red line. Price growth in Denver is slowing. And it's really because other cities have now caught up or have overtaken us. Denver year over year is at about 10% single-family home price. Las Vegas in the last 12 months has come up 28%. Northern and Southern California up 25%. So this is just statistics, as Denver didn't have all of the recovery that some of these other markets did. So for a while we're going to be underperforming on the statistical side. No worries at all. In the last 12 months, 92% of all of the zip codes in the United States saw home price appreciation. So we're through this now. We just need to normalize, move some of the investment out, build more new homes, loosen up mortgage, housing market, one more really good year, 2014. Got to talk about consumers for a second. They are healthier. They're upright. They're not walking fast. They're certainly not running, but they are around. But I'm a little worried about the consumer side, as I kind of hinted before. The net worth is looking good. If you look at total net worth of households in the United States, we've recovered everything we've lost in the last 6 years, total net worth. But if you look at household net worth as a percentage of disposable income, which is maybe a more important measure, we're only about halfway up to where we were at the peak. Now, I'm not sure we're going to get back all the way to that peak. I'm not sure we need to, because a lot of that was home equity inflated wealth. About 2/3 of family wealth is in homes, and so as homes lift, household net worth comes up. All I wanted to do is get to about 600 there. If you look at that right-hand y-axis, that's where I think it needs to be on an index basis, because we're not going to get back to 650 quickly. We don't want it to get back to 650 quickly. Debt to disposable income is the most important measure. Total debt is still climbing. I'm not worried about total debt for the most part. I am a little worried about student debt. There's about $1 trillion of student debt out there, and it's growing quickly. I could talk about education. Someone asked this morning, do you see a problem with education? I do, but I'm not going to talk about that. But we do see educational debt moving up. It's about 8% of total debt. It's nothing near what subprime is, so it's not going to take us down again. But that continual rise in student debt is a worry. Secondly, I worry about the term of the debt. Something like, I can't remember how much, it's a big proportion of new car debt is over 5 years. It's not just taking out loans on a new car, it's taking out 6- and 8-year loans on new cars. It's just long-term debt. Now with low rates, maybe it's all right, but I do worry about the term of that debt matching long-term income coming in, just a balance sheet thing. Poverty rate is up. It's up to about 15% now. It was 12% in 2008. So there is still disintermediation in the populace. We're not rich at all. Yes, households are moving up in terms of their net worth because of their house price, but it's not, most don't participate in the stock market. I think the top 10% of earners own 90% of the stocks. So the stock market, even though it's good for probably everyone in this room, doesn't help a lot of people. There's just not a lot of money out there still, which is why people are availing themselves of unemployment benefits and disability insurance benefits, why 1 in 7 people in the United States are on food stamps today. It's still not a robust economy. It looks better than it did, but it's still a long way from healthy, which makes me worry about this slide, retail sales. The impression I have had in the last 2 years is we've done pretty well, and we kind of have. If you look at that July 12 big spike, and then again late 12 and early 13, retail sales were okay. But if you look at that whole chart, squint your eyes, and put your hand on the slope of the trend, it's heading down, and I think that that really is important. I don't think retail sales are moving in the direction that they should be. There is a downtrend, and I think we're probably going to get cold for Christmas. Consumer confidence is low, part of that being government shutdown, but it seems to be lasting beyond that. Some of the newest consumer confidence data that's come out in just the last few days, well past the old shutdown, is consumers are feeling shaky about spending. And I think that that's the case. So while this recovery seems to be gaining steam, consumers seem to be pulling it back, we need business to maybe offset it, but I just don't like the look of what I see in retail. Shopper confidence is low. Another problem we're going to have this Christmas is there's 6 fewer days between Thanksgiving and Christmas, so a holiday shopping period is going to be constrained. That's not going to do well. And then finally, if you look at the back-to-school sales that we had, they were pretty lukewarm, especially on the apparel side. So I'm not seeing anything that gives me a sense that retail is going to look good come in the next 2 months. All right, this is why we're here. Commercial real estate, how's it doing? I'm going to show you something that you wouldn't expect to see, but something that I look at with some of our institutional investors. They don't see commercial real estate with very narrow vision, they see it in broader vision, and this is broadening even further. First of all, you have to look at real estate performance against the S&P performance. S&P stock market, 21% as of mid-year, not too bad. Down in the fall, but now back up. Real estate doing pretty well also, according to, this is NCREIF data. But what's interesting is where some of the real return is coming from is in some of the non-traditional sectors. Farms, for example, up 20%. That's capital appreciation in the land, but it's also a chase for yield. A lot of institutions are trying to get yield, as you guys well know, and they want your rent growth, they want your cash flow. Farms are throwing off a lot more cash flow, and so is senior housing right now than some of the other more traditional classes. And so farms, senior housing, 16%. And then you get into more the classic stuff, retail, medical, apartments, industrial, in that REIT range. Office, timber is lagged for some reasons, partly weather, and then hotel is the lag in all of that. If you look at value under peak, though, it gives you a sense of what's yet needs to happen. Retail value under where it was in retail and apartments is close to recovering. It's only 7% below where it was 7 years ago, 6 years ago. So those two categories are doing okay. What's still not doing well is industrial office and especially hotel. They have not recovered that value. And so I do think that there's going to be a shift to some of these other categories in the next 2 years, because even though there is a thirst for yield, there is also a hunger for total return. And I do think that you're going to see money moving to more risk positions. If we can get more good news, more steady news out of the economy, you're going to see more money moving into more opportunistic kinds of categories than we've seen before, into land, into hotels and office, into small cities, Fort Collins or Omaha or what have you. I do think money is going to be shifting into those opportunities, and eventually we'll see development, but it's not going to come to us in the way it has in the past. And here's the slide that talks about that. I don't think we're going to see a lot of new supply. That's sort of the best and the worst news about commercial real estate, is we haven't had much, and these lines show the general drifting down. U.S. commercial real estate as a percent of inventory, completions as a percent of inventory, has been coming down now for 20 years. And I think this is not just economic, this is really structural as well, as I do believe that we are going to use less real estate per worker, per spender, per manufacturer than we have in the past. That's not necessarily bad news. It just means that as you see population grow, as you see employment grow, we're not going to build the same amount of commercial real estate that we used to. It does mean, however, that you're going to see more adaptive reuse. I think you're going to see massive remodeling projects going on in, for example, office space. We've already seen a couple of waves of that, office to apartment, but I think you're seeing in a number of cities now office space which has been not quite obsolete, maybe in not exactly the right location, now being remodeled into something that's this cool workspace. I think you're going to see more and more of that. And so we won't see as much new space per capita, but I think you're going to have just as much functional or more functional space per capita. Apartments, by the way, are upticking there. You see a little blue tail on that. Apartments are upticking. It's got another 2 years to run, and then that will even out as well, I think. We're not going to stop building apartments. We're just not going to outperform everything else. Cap rates. I'm constantly asked about what's going to happen with cap rates, which is linked to the question, what's going to happen with interest rates? And it's the same answer. I don't think interest rates are really going to go anywhere. I really don't think cap rates are going to move that far. They're not going to come down anymore. This worry about interest rates is going to keep pressure on cap rates, both up and down. I don't think you're not going to see them come up. I don't think you can see them come down a lot more either. And it's because of the spread to safe rates. Historically, you've had real estate here, you've had 10 years here, and you've had 200 to 300 basis points in between them to cover the risk premium between them. I think that's probably going to continue, and if you look at this red to blue right now, that spread is 400, which means that there's probably a little bit of scope for interest rates to move, safe rates even to move, before you get a cap rate move with it sympathetically. And so I don't see cap rates moving a lot, moving very quickly up. They're not going to go down any further, I don't believe, but they're not going to come up as quickly as many think. And that, I think, is good news for our industry as well. Howard said this morning, and I tend to agree with him, look for 2 more years of pretty flat interest rates with a little bit of gyration. The next 2 years, I don't see any real surprises in capital appreciation or capital value either. I think that's good news. Lastly, about Denver, and I'm going to leave to this afternoon's panel the detailed discussion about the various product types and what's going to happen. But you see the red line being office and then industrial retail apartment at the low end. This is vacancy rates in Denver. Office is the laggard. Office tends to be the laggard at about 16%. It's moving in the right direction, but we are going to have to, I think, contend with more absorption and more adaptive reuse before you really get to the point where you can build a lot of new space. Yes, we built a new building 3 years ago. Yes, there are a couple of new ones in Lodo, et cetera. There is new space being built, but there's still a ton of space out there that needs to be improved, functionally improved in some fashion. Retail is a bit of the same. Retail is plagued by sort of Class C dysfunctional space, and I do think we're going to need a new breed of retailers coming in to use that as well. But all of this is sort of trumped by one statistic, is real rents are growing in every one of these categories, real rents, and that's important. We're finally seeing real rents grow. Apartments have actually recovered their previous high on real rents, which was in 2001, and by real, everyone here knows that it's inflation adjusted, which is important. You can't just look at year-over-year growth. You have to look at inflation-adjusted growth. Yes, inflation is low, but in order to really make money, you've got to create alpha, which means you need real rent growth. And we're getting real rent growth now in every one of these categories in Denver and most places in the United States. That yield, that cash flow, is going to be critical in the next 2 years for investment. And that's why I believe that you're going to have a lot of money pouring into real estate because it wants that yield and it wants that cap appreciation stability, even if cap rates aren't going to go down further. The spaceship. All right, so what's going to happen in the future? And I'm going to sum it up very, very quickly, the economics. 2014, again, as I've said, is the year of the house. It's the sequel. Economic growth will be better. This year we'll be lucky to get to the high 1s because of the government drag. Next year we'll get into the probably mid 2s. There will be some government drag next year, but not nearly as much. I don't think interest rates are going to be a problem, as I've said. I don't think that 10 years will be higher than 3.3 to 3.4 by the end of next year, which most of my friends are astonished to hear, but I really don't think that they're going to move that far. Home mortgages probably won't be above 5% by the end of 2014, and unemployment is not going to be below 7% because of this lift in participation rates. Okay, so 2015, how does that look? That's my year. That always has been my year because as I looked at my charts, my pointy-headed little graph charts 3 years ago and did all of this extrapolation to when does household debt to income normalize, when do the banks do well, when does job growth really start for some reasons. It all started in my old charts, 2014 to 2015, and it's still there. 2015 is going to be not the year of the house anymore, it's going to be the year of the paycheck. And you're finally going to get income growth. You're going to have a strong consumer sector, which is going to reinforce the business sector. They're going to get into CapEx in buildings again. And 2015 actually is going to be a pretty good year, I think. GDP 3.5%. Interest rates are going to be up, but I don't think the 10 years are going to be much more than 4% by then, believe it or not. 6% home mortgages, which are still terrific. I just really like the looks of 2015, and one more reason I like it is all of those baby boomers moving out of your basements are going to realize that, yes, I do want to get married, yes, I do want to have children, yes, I do want to start buying things again, and there's going to be a baby boom, so buy pregnancy tests and houses and baby food, maybe not in that order, but I mean, I would buy those stocks because 2015, I think, is going to be the beginning of the millennial plus one generation, and you're going to get a whole new set of workers, you're going to get a whole new set of spending, the spending is going to manifest differently. 15 is going to be a very interesting year, I think, for us. One more thing I want to show you. My favorite political cartoon ever. Tom Towles is a Washington Post cartoonist, and this came out about 15 years ago. I can't find the original, so I had our illustrator copy it. But if you can't see it, it's a couple sitting out on a sunny day, picnic, happy, wonderful day. Next column, next panel. Sky opens up, this ugly monster, economic crisis. The guy looks up at it, alarmed, girl doesn't see it. Next, did you see that? No, I didn't see it. He settles back, oh, me either. That, I think, is really what part of our problem is I just don't think that we really recognize sort of what economic crisis is. I don't think we really are equipped, either public or private sector, to deal, more private, but public sector isn't equipped to deal with what economic crisis is and the fixes for it. And so I'm sending this Towles cartoon to Washington again with our senators. Thanks very much.
Keep moving. Thank you, Rick. There is a new value indicator. It's called RIR. It's no longer IRR. RIR stands for Rick is right, and he's right 91% of the time. Our next speaker is Kay Sargent, and please stay to listen to Kay because she is dynamite. I heard her for the first time about 9 months ago. She is with Technion out of the DC office and has flown here to speak to you today. She does not use the word furniture at all in her speech. It's all about the workforce and a healthy environment. It's a great, great talk, so please stay seated and please welcome, where are you, Kay? Are you there? Welcome, Kay Sargent. Thank you.
All right, are we all encouraged now by 2015 and where we're going? Hopefully, yes. The best thing that I heard, well, I should kind of give you some ground rules. I have 5 kids. So, Rick, thank you very much for confirming that they will actually one day all move out of my house. That's really good news for me to hear. As someone who has 5 children, I will tell you I'm probably the only speaker that will ever say, I don't care whether you turn your cell phones off or text all the way through my presentation. I get it every night at dinner, so bring it on. You might end up doing the dishes after lunch, but bring it on. My job with Technion, after being a designer, a principal of a major architectural firm, traveling all around the world for 27 years, I joined Technion about 2 years ago, and now I get to eat my way across the country, talking about my favorite subject with some of the greatest people in the world. And I get to look on the horizon about what do we see coming, what's happening, and what do you need to know. So I have some bad news, but also hopefully some good news to share with you all. So as we talk about design going forward, I'm going to argue that for the last 4 years, we have been so concerned about reducing our real estate footprint and reducing risk, about making sure that our buildings are sustainable, and about the impact that technology is having on us, that we've basically forgotten who ultimately we're designing for. People. People are our #1 asset. And we've gotten to a point now that they're not really functioning as well as they could be. So a little quiz time. What percentage of people do you think are sleepwalking through the day? What do you think? Anybody want to shout it out? 72%. Who said that? You're my hero. You're reading the same articles I am, right? Okay, so originally, and you know what? I'm going to admit, and I don't do this often, that I'm actually wrong on something and she's right. In here it says 70%, but a new study came out 2 days ago that now upped that number to 72. And you know what's sad about that? The US is rocking it with only 30% of our workforce engaged. In China, only 6% of their workforce is engaged. This study that came out by Gallup basically shows that 1 in 3 Americans is not engaged. Not at all. And 52% are basically showing up. There's this little thing we're dealing with today called presenteeism. People are there, but they might as well not even be there because they're not really all in. Now, I want everybody to look at me if you're with your coworkers right now. You are not allowed to look at anybody else in the audience for the next few minutes. This same study said that most companies would be better off having 15% of their employees go home. We will pay you to go away because you are so negative. You're bringing everybody down. Go home. That's frightening. And so as a designer and as a consultant, I travel all around and everybody's like, we want to improve productivity. You better want to improve productivity because it's bad. And in the workplace community right now, one of the biggest debates is how do you measure productivity? Let's put little sensors on chairs and let's do all this other crazy stuff. And how do we measure productivity? I'm going to tell you, I don't give a damn how you measure productivity. It's bad. What I care about is how do you improve it? Because we're going to spend all this time trying to figure out how to measure it, but not have done a damn thing to improve it. So I'm going to put $1,000 on the table that says a happy, healthy, engaged, empowered worker is going to be more productive for you any day of the week than a pissed off, disgruntled, unhappy, unengaged worker. Anybody want to argue that? So guess what? You get to go home and say you found the key to productivity. Happy, healthy, engaged, empowered workers. So, another question for you. What time of day do you think you're most productive? What do you think? You guys are being way too polite. You can shout out. I'm giving you permission to yell at me. Morning? Morning, morning? Most people say that they are either an owl or a lark. First thing in the morning or late in the afternoon. And by the way, if you want a copy of this presentation, I'm more than happy to because I'm going to go through a ton of information pretty quickly. You're either an owl or a lark. Where are you when you're most productive? Not at work. Have you ever heard anybody say, man, I am rocking it at 2 o'clock in the afternoon. I mean, 2 o'clock, man, that's my sweet spot. Man, I'm killing it. The only people that say that they're killing it at 2 o'clock in the afternoon are students. And let's just be honest, they just woke up at noon, so they're basically lying anyway, right? Like, screw them, right? Don't even listen. At 2 o'clock in the afternoon, we're dying. Our circadian rhythms are dropping. We're dying. That's why 5-hour energy is so important, right? I mean, this is why they sell millions of bottles of this a day. We're living on this stuff. By the way, where are you when you're least productive? At work. So when people say to us, we want to improve productivity, maybe you need to think about when people are naturally most productive and allow them to work in those natural cycles and stop fighting the obvious. When do you think you do your best thinking? Or where, excuse me, do you think you do your best thinking? I'm going to give you some choices and some options, okay? Your choices are the commute, the shower, exercising, vacation, or the office. What do you think? All right, who said sleeping? Okay, you, my friend, are right. The right answer isn't even actually on this chart. By the way, you guys do know that 99% of all statistics are made up, right? Okay, this actually isn't made up, but the right answer isn't really even technically on here. Per this survey that we did, the right answer is more people said that they were productive during the commute, or they got their best idea during the commute, or exercising. That 1%, I kind of made that up because nobody said they were most productive or got their big idea at the office. Not one person in the survey said that. That's frightening, right? Because right now the big thing is designing all these collaborative spaces so people can come up with these great big ideas. Is it working? No. So maybe what's happening is that we're commuting or exercising in the morning or evening, so it's in our natural cycle. But it also could be that we get in a zone. And I'm sorry to admit this, but have you guys ever gotten to the office and you're like, whoa, I don't even remember getting off the highway and I'm already at the office? Right? These are activities that you tend to kind of get into a zone, and that's when you do your best thinking. And my friend who said sleep, you are correct. The real right answer is that we really do our best thinking right before we fall asleep because we're tired. We let our guard down. We let our minds wander. And that's when we get really, really creative and get our big ideas. So, what is so negatively impacting us in the workplace today? Why aren't we working well and why are we so disengaged? I'm going to argue that we have a little bit too much of a good thing. Okay? Collaboration is probably the most overused and most misunderstood word that's out there today. Everybody's talking about, well, we've got to create these collaborative environments. I sat in an open architectural studio for years. I know more about Kim Kardashian than I never, ever, ever wanted to know. That is not collaboration. That is mindless chit-chat and chatter. Is that what your clients are looking for? Because that's what we're giving them, right? I believe that collaboration happens when people bond. When you bond, you trust. When you trust, you open up. When you open up, you innovate. A lot of people don't innovate in open collaborative spaces. A study came out about a year ago from Virginia Tech that said introverts totally shut down in open environments because it's not a safe zone. And so we need to think about what we're really trying to achieve. But the lesson is open does not equal collaborative. And so we need to think about what we're really trying to achieve as we go forward. There's a great book by Susan Cain called The Power of the Introvert. Power of the Introvert in a World That Won't Stop Talking. And she talks about how we really need to do heads down concentrative work. Even people that are highly collaborative say they spend about 50% of their time doing heads down concentrative work. Now, if you don't want to read the book, there's a great 18-minute TED Talk that I highly recommend. But we need to get back to the ability to focus. So there is a refocus on focus today as we move forward. So what's distracting us? I'm going to argue that technology has made us incredibly more productive. In fact, a recent study showed that over the last 5 years, technology has increased our ability to be productive by 500%. It's pretty high. And in the next 5 years, it will continue to increase our productivity, but only by 22%. Meaning we've kind of peaked. In fact, I'd actually argue that we've started to go down the other direction. That technology today is actually a hindrance to productivity. That it is becoming so distracting that it's often waylaying people from really doing what they need to do. We go in, we turn on our computers, we start getting emails, and that list of really important things you have to do just sit there. Right? All of a sudden, you're into this mode of doing email triage and email volleyball, and you're trying to get it out of your inbox faster than it's coming in, right? That's not productive at all. Technology today is running us. We are not running technology. And we need to get that formula right because it's going to negatively impact us. So how often do you think the average person checks their phone? How many minutes between looking at your phone do you think the average person goes through in a day? Every 7 minutes. Now, I want you to think about that. You're not just looking at it, yep, it's still there, and putting it away. You're like, ooh, wow, I got to talk to her. Nope, delete, ooh, forget that one, look at that. They say the average person looks at an email 5 to 7 times before they actually really read it, process it, and answer it. Do you know how much time that wastes? A tremendous amount. And then we just forget about it too, right? There's something called the ping effect. Okay, so if you drink on the job, which in our industry nobody does, right? If you drink on the job, they say it reduces your cognitive ability by 10%. I didn't think that was that bad. I actually, when I first read that, I'm like, really, that's it? There are some meetings that I am willing to be 10% stupider for because I need to have a drink before I go. Sign me up right now. Okay? But there's this thing called the ping factor that they believe is actually more detrimental to us than almost anything else we're encountering today. And it reduces your cognitive ability by 20%. So what makes you twice as stupid as drinking on the job? Ping, 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 ping. That constant pinging of your email, IMs, your social media. They say to get to any deep, meaningful thought, it takes 15 minutes. But on average, we're interrupted every 7. If you've got IM, social media, texting, link, any of those things, you're probably going to be interrupted every 2. To get back to any deep, meaningful thought now takes 20 minutes. Because you've got to remember, did I read that? Did I respond to that? Did I send that email? Did I not send that? Where was I? We are designing environments where we are constantly fueled by technology that are prohibiting us from getting to any deep, meaningful thought. I had a designer recently say to me, I can't think at work anymore. And, I need to think. And I kind of laughed and I said, well, that's kind of a noble endeavor. I'd like to believe everybody thinks at work. She goes, but I can't think anymore. And if I stop and think at the office, about 3 seconds and everybody looks at you like you're an idiot. Like, what are you doing? Right? She said she has to perfect the art of fake typing so people don't think she's daydreaming at work and she can actually think. That's sad when you realize that. So we need to get the ping factor under control because today we are inundated with distractions. We are overwhelmed. It's like everybody on the planet has ADHD, right? Like more squirrels are out there, squirrel, than ever before, right? We cannot focus on anything. We have a whole new vocabulary about this, nomophobia, the fear of being without your phone. How many of you all, be honest, if you left and went to the office and halfway to the office you realized you forgot your cell phone, how many of you would turn around and go get it? Okay, notice no millennials raise their hands. Sorry, I'm an equal opportunity offender. I'll bust on the baby boomers later. The millennials wouldn't go back and get it. You know why? They wouldn't get past the end of the driveway before they knew, do I have to go left or right? Where's my GPS? I got to figure that out. When my 16-year-old son got his driver's license, I didn't worry about him getting in a wreck. I worried about him getting lost to the 7-Eleven that he'd been going at for the last 16 years that was less than a mile down the road. He's never going to come back home. He doesn't have his phone. He's going to be lost. He's never going to make it back. I also love, if you look on here, the walking dread. The fear of being stuck behind a weaving sidewalk texter as they're kind of staggering down the hallway. I love this. Tech detox. This is a big issue now, right? Because they realize we're getting obsessed with this. So we have camps now that are specifically designed to help you get off your technology. Camp Grounded, 3 days specifically for adults, $30,000. And they have a waiting list. What percentage of Americans do you think feel the physical embodiment of stress every day. And I'm not just saying, ooh, I'm a little stressed out. I mean, like, heart is palpitating, hair is sticking up on the back of your neck, you're sweating. What percentage? Okay, in our industry, it's probably more like 90, 95, but for the rest of them out there, it's about 70%. That's unbelievable. 2 years ago, when they started talking about what are the biggest issues that we're going to be dealing with in the workforce, emotional stress topped that list. And I thought, really? Come on. I've been working for 30 years. It's always been stressful. Really? You know, what's this? But if you think about it, it really is more stressful. We are always on. Always. There are companies, VW, that have decided this is becoming such a big issue that we're going to shut down our servers at 5 o'clock and we're not pushing emails through anymore. And we're not letting emails come through to our people on the weekends. France, Australia, and Brazil all have legislation on the books that say if you respond to an email on the weekend, you should get paid overtime to do so. That is so not the debate in this country. The debate in this country is define overtime, right? Because you were Facebooking in the middle of the day. So if you want me to pay you for answering an email on the weekend, do I dock you for Facebooking in the middle of the day? And it really does go both ways, right? 5 kids, I used to have to wait until 6 o'clock at night to find out all the stupid things those kids had done during the day. Now, I get text by text messages all day long, blow by blow. Right before I got up here, you know, the crisis I was dealing with? My 21-year-old daughter, who's in college, is in line in Starbucks, and she has a 0 balance on her card. Ooh. I don't give a crap. And why are you at Starbucks anyway, right? But I get that now. So it goes both ways. It's not just work interfering with our personal life. Our personal life is creeping into our work, too. It's total blended today. And all of this means we are constantly on and we are constantly under stress. This is such a big issue that the Mayo Clinic now has an area specifically to study this because they believe we're losing control. Technology is running us. They have a clinic specifically to help you enhanced attention. Practicing presence. Next time you go to dinner, look at how many people are texting and not even talking to the person across from them. Or anybody have teenagers in this room? Right, you have all these teenagers come to your house and then they sit on the couch and text other people. Or text each other because they're too far away on the couch to talk, right? Practicing presence. Attention therapy. The Mayo Clinic is so concerned about this that they actually believe this will be the ultimate downfall of our society. Because if you're not really getting to deep, meaningful thought, you're going to progress. But are you progressing in a meaningful way? Or are we all just going to wake up one morning and be like, whoa, when did robots start taking over everything? How'd that happen? Right? And if you aren't progressing in a meaningful way, you're actually digressing. And so we need to think about that as we go forward. And by the way, if that's not enough, even your technology knows that you need to turn it off every now and then. When your technology is smarter than us, and I'd argue for some of us that was a long time ago, it's telling you there are more than 10 apps that you can get now that tell you, turn me off, ignore me for a while, go relax. We need to take that advice. Well-being is a huge issue in the workplace today. 2 years ago, when we started talking about this topic, people were like, oh yeah, you're talking about putting a fitness center in, right? No. The concept of well-being is basically this. Sitting stagnantly in a chair is killing you faster than what any wall is off-gassing. What are we doing about the occupants? And it's not enough to eat well and go exercise. If you went to the gym this morning and you're eating healthy and you're thinking, man, I'm in great shape. But if your personal life is a mess, your career is a mess, your financial situation, your community, any of those types of things, that stresses you out. And so we're looking at holistic well-being. And if you're not holistically well, we need to start addressing that. So we've done a lot of work with Healthways, a company out of Nashville who partners with Gallup, and they do these studies, and they have come up with this way to determine what your well-being index is. And basically, they assess that and grade it. They look at your life evaluation. They look at your emotional health, your physical health, your healthy behaviors, your work environment, because where do you spend the majority of your day, right? And access to basic care. And they assess all those things, and they give you a grade and a score. How do you think your state of Colorado does? Good? Bad? In the middle? You guys actually fare pretty well. If you look up on the charts, green is the top quadrant. So you're in the top quadrant. Then it's followed by blue, yellow, orange, and red. Anybody shocked by those numbers? Look at the South. Look at the Southeast. Macaroni and cheese is considered a vegetable in the South. That's the land that brought you chicken and waffles for breakfast. And if it isn't fried twice, it isn't fried enough. Now, if you look at these numbers and you look at well-being and how it overlays with obesity, diabetes, and physical inactivity, there's a direct correlation between all of those things. In 1985, the Center for Disease Control decided, you know, we have a little bit of a problem here. I think we need to start looking at this and start assessing how people are doing. And so the states that are in white had absolutely no data on obesity. The states that are in light blue, they found that less than 10% of the women in those states were considered obese, or 30 pounds overweight. And the states in the darker blue, 10 to 14% of women in those states were considered obese. Let's look at what happens over time. Colorado just fell. Now we have to add a new color. In these states, 15 to 19% of the women are considered obese. New color, 20%. That was a bad year. New color, 25% of the women are considered 30 pounds overweight or obese. Sorry. New color, 25% or 30%. But who's the lone holdout? Come on, Colorado, come on, Colorado, come on, Colorado, come on, come on, come on. Oh, wow. Do you think we have a problem? This is a huge issue. And by the way, men, if you're sitting there thinking, this is women, man. Men, you are just as bad. And children, I got to tell you, it would actually make you cry. 60% of adults don't get their daily recommended amount of exercise. 70% of our children don't. Exercise today is this for kids. We've got a real issue. So why? What's changed? Well, I want you to think about it. Two big things: how we work and what we eat. We're eating more genetically modified food, and we're not eating things that are locally grown. Blueberries are always in season, but you know what? They're really not. The only reason you can get them is because we're shipping them in from all over the place. Have you guys heard of zip code honey? Okay, if you think about this, we used to eat a lot of honey, and we used to eat things that were locally grown. Bees are natural pollinators. They go around, they pollinate all the plants, then you eat the honey. It's like giving you a little immunity shot to all those local pollens. But we don't eat that anymore. We're not getting our little immunity shot, and we're eating foods that are coming from all over the world, and so we're getting exposed to all those different things that are in those foods and in their ecosystems. Have you ever noticed why all of a sudden everybody has allergies to everything? Right? That wasn't happening 30 years ago. It's a lot of that it has to do with what we're eating. The other thing is how we're working. 100 years ago, we were manufacturing, mining, and agricultural-based society. The concept of the modern office has really only been around for about 80 years. The concept of sitting stagnantly all day staring at a computer screen, well, that's only been around for about 25 years ago. When I graduated from design school 30 years ago, I was drafting. We didn't even have computers. We didn't have the fax machine. We didn't have cell phones, anything. We were up and we were much more physical. But now we've become much more sedentary. And if you think about it, 8 years ago when we got smartphones, now we can be sedentary anywhere and everywhere we go. And so we need to start thinking about how unactive we're becoming. Oh, I live in Washington, D.C. All my neighbors got a 3-week paid vacation a few weeks ago, which still really pisses me off. But the big debate, the reason they got that, is because we're so worried about how do we pay for health care in this country. 88% of the money that we spend in this country for health care goes to how do we pay for access to care. 8% goes to whatever, 4% goes to our healthy behaviors. But let's look at what are the real influencers about your health. Only 10% of what influences your well-being and your health has to do with access to care. 20% has to do with environment. Your physical environment, your work environments, things that we can contribute to. 20% has to do with your genetics. Mom and dad can't do anything about that. 50% has to do with your healthy behaviors, your personal choices. And so the head of Healthway spoke recently at a big conference in Dallas, and he said, we've got the whole debate wrong. We have got to stop fighting over how we pay to help people once they've gotten sick and start asking, why the hell is everybody so sick in the first place? And start being more proactive so we're not getting to that point. Healthy behaviors. American Medical Association and the Centers for Disease Control recently determined and qualified obesity as a disease. And when they did that about a month or two ago, it instantly went to epidemic status. What does that mean? It means that now it can be covered under your health care. It also means, in our litigious society, how long do you think it's going to be before we have the first class action lawsuit with a bunch of employees suing their employer because they are forced to sit at a desk all day and work or not get breaks or not get up or whatever? And that's going to impact everybody in our industry. And I guarantee that's coming. So we need to start thinking about how do we design environments to get people more active and healthier. Because we need to start thinking about why are we so disengaged and why are we so unhealthy? How much time do you think the average person stands? 24 hours in a day. What do you think? 30 minutes? Oh my God. You can't even go to the bathroom in 30 minutes. No, just kidding. How much time do you think the average person stands? This basically is a study that was done in Australia, but they're showing that it's very similar to what's going on in North America right now. They say between sleeping all night, then we get up, we sit on the commute on the way to the office. We sit at the office. Most people spend about 90% of their time at the office sitting, either in meetings or at their desk. We go home, we sit at meals, we sit on the commute, we sit watching television, we sit Facebooking. After all of that is said and done, the average person is only standing 73 minutes a day, let alone exercising or doing anything else. That's frightening when you think about that. Our bodies were not meant to sit for that long of a period of time. We were meant to be active and more mobile. Sitting, sitting is killing us. They say that if you sit for more than 2 hours at a stretch, no amount of exercise can reverse the negative impact of that. Go out and run a marathon, I don't care. It's not going to negatively impact or erase what you just did. They say that if you sit for more 4 than 5 hours a day, it has the equivalent on your health of smoking 2 packs of cigarettes a day. Some people will argue that sitting for long periods is more damaging than smoking. When you sit, your whole body reacts. Your head, your lungs, your arms, your stomach, your neck, your heart, your legs, everything starts to shut down. Your electrical activity starts to shut down. Calorie burn drops significantly. Enzymes start to build up. Your good cholesterol drops. They say that the closest you get to death is sneezing. The second closest you get to death is sitting, watching television, because there is nothing that is worse for you probably than doing that. So we need to get people up, active, and moving. How many of you guys have seen the movie WALL-E? Okay, do you remember what happens to the people in WALL-E? Anyone shout it out? They become fat. They become total lethargic slugs. We are so over-conveniencing them that they don't even have to move anymore. So I want you to think about this. Do you have a trash can by every chair in your house? Kind of obsessive, right? Why the hell do you need one by every desk in your office? Are we really that lazy that we can't get up and walk 5 feet to a trash can? Really? We are so concerned about over-conveniencing people today that this is what we're heading for. And this is not the goal of what we should be trying to do. These guys, by the way, are talking to each other, and they're looking at each other on the screen because they can't even turn their necks. And you laugh at that, but how many times, again, are teenagers, how many times do you see teenagers texting each other and they're in the same room? We're there. Sky Mall, $8,000. We need to start thinking about how we get people up and active because that's not the reality of what we want. Sitting is becoming the smoking of our generation. So how do we avoid that fate? Well, the most flexible thing in any environment is the people. We've always designed space like it's a one-room efficiency apartment. You go, you sit in one spot, and you're never supposed to move. Like we're potted plants. But the bottom line is we're much more productive in a single family home environment where I can go to different areas that are designed for different tasks. When I want to cook, I go to the kitchen. When I want to hang out, I go to the living room. When I want to brush my teeth, I go to the bathroom. When I want to sleep, I go to the bedroom. We are focused on the task at hand. We get it done. We move on. Yet in the office, everything is right there in front of you, and you're totally distracted and totally overwhelmed, and so you're probably not being as effective. Walls, furniture, those are great to have those be flexible, but we cannot forget that the most flexible thing is the people. We've got to start designing spaces to get them up. And so there's this whole new concept of activity-based design. Don't make people sit in one space all day. They just slowly start to erode their brains. They get tired. They're not energized. Presenteeism is rampant. We need to start giving people areas. So people need to collaborate. Give them spaces where they can go collaborate. Give them kitchen tables where they can hang out and exchange ideas. Give them open plans. You know what you get in an open plan? Not a lot of collaboration, but what you probably get is an energy, a buzz, a vibe. We love being together. Lower panels so they have access to natural daylight and are stimulated. But you've got to balance that with quiet rooms where people can think, where they can read. Maybe some benching for people that are just coming in occasionally and not going to be there for long periods. One of the biggest trends we're seeing right now is stand-up high conference tables. Stand-up high desks in the conference rooms, no chairs, no technology. Those hour-long staff meetings get done in 15 minutes, and I've never seen anybody fall asleep while they're standing up. Focused, on point, let's move it, right? But you also need to talk about areas where people can bond. They can collaborate. Communal spaces, casual areas. So in 2006, we designed offices like they were a series of one-room efficiency apartments. Remember that old zoo model where all the animals were in individual little pens? Kind of looks like that, right? In 2008, we had the big crash. And everybody decided, oh my God, we got to squeeze everybody in. Benching is working in London. Let's bring that over because we're exactly like people in London, right? We eat bangers and mash, drive on the wrong side of the road, and ran out of space decades ago. We're not exactly like the people in London. And so it might work for some people some of the time, but tell somebody in Texas that they have to sit in a bench because people in London are out of space. That's not going to go over well, okay? So this works for some people some of the time, but not all of the people all of the time. In 2011, Bank of America, Best Buy, Yahoo. You know what? We're totally untethered. Send everybody home. You want to save money on real estate? Send them home. Let them all work from home for a while. The office is just a place that you're going to come and gather and hang out. How'd that work? Okay, I'm going to argue for some companies it didn't work too badly, but for a lot of people it totally eroded their corporate culture, and they started to bring them back. So in 2013, I'd like to believe that we've gotten to a point that we realize one size misfits all. We need to give people options and choices. We are no longer assembly line workers that are passing a widget down a line and doing the same thing 40 hours a week. What I do Monday morning could be very different than what I do Tuesday afternoon, could be different than what I do Thursday. I need a variety of options and variety of choices, right? Because we need to change. So there's a huge shift in work today. We can work anytime, anywhere. A lot of people are wondering, do we even need offices anymore? Well, I think we've come to the realization that, yeah, we do. Because people like to come together, and if you don't give them an office to go to, by the way, they're going to find their own, all these co-working centers, et cetera, that we see cropping up all around the country. The real reason people are coming to a place is to collaborate and to engage each other and the work. And so the real question that we need to be asking is, if that's why people are coming to the office, are we providing them environments that are engaging? Are they stimulating? Do they remind them of the mission of the company? Are they inspiring them? Are they branded to what they're trying to do? Do they connect them to their peers? Do they allow you to engage a paper and read, but at the same time be able to engage your coworkers and collaborate and communicate? So we have the old model, which is a series of one-room efficiency apartments, just a whole building of them, versus the new model, which is kind of like that single-family home where there are options, choices, and a variety. That's how you accommodate the diversity that we have in the workplace today. You need to provide a variety of settings with lots of information sharing. That's how we're going to get to stimulated environments that really lead to innovative work. Now, teleworking is a big thing that we're dealing with as well today. What generation do you think is teleworking the most? You've got the millennials, you've got the Xers, the baby boomers, and the veterans. Who do you think is teleworking the most? Somebody said the millennials. The millennials came up with the idea, and boy, did it piss everybody else off, right? It's like, you just showed up and you want to go work from home? Are you kidding me? If anybody's going to get to work from home, it's going to be us. The generation that's working from home the most is the Xers and the baby boomers. They're the ones that probably have kids, have aging parents, are more likely to live in the suburbs, have what I'm going to call tenure, right? They know the system, they know what's expected, people know what's expected of them. They're the ones that probably just realize that they may not be retiring when they're 65. They could be working a little bit longer. And do they really still want to fight traffic 5 days a week? No. So they're looking for that softer retirement. The millennials have everything to gain from coming together. They are the we-evolution. They do everything in packs. They want to make their mark. And they're not going to make their mark when nobody's going to see it. So they want to be there and make that pact. So some people have said we've gotten to this. I jokingly thought we should wear cargo pants at NeoCon last year, the big furniture show, but we do sell furniture. Nobody else thought that was really funny. But the bottom line is that I don't think offices are going to go away, but they're going to change. So we have 4 different models today. We have mobility. You go to where the work is, whether that's external or internal. Some people leave the office every day. They go to their building, and they're all over the building, internally mobile. Then you've got some people that leave their house every day, and they're going to client sites. They're going to job sites. They're going all over. They're externally mobile. Then you've got teleworking. You kind of are a potted plant, and the work comes to you, not the other way around. Then we had our third places that started cropping up, right? The Starbucks, the Paneras, all those places. You can't even sit in those places anymore because everybody's there working. And now we have co-working centers. There are over 2,500 co-working centers in the United States alone, and a rash of them throughout Europe. These are basically like work gyms where you can go, you have a membership. They're little incubators that are starting to crop up all around the country. Because 1/3 of the workforce today is self-employed. That's staggering when you think about that, 1/3. And a lot of them don't necessarily want to work from home all the time. So what percentage of people do you think that can work from home actually do? Anybody want to shout out? What do you think? 25%. Did somebody say 10? You are right. You guys are smart. Only 10% of the people that are actually told you can go work from home actually do. Microsoft was so disturbed by that, they did a study. And they came up with what are the top roadblocks and obstacles to why people aren't working from home. Well, the first one is technology limitations. You've got BIM, you've got a firewall, you've got bad cell service in your neighborhood, whatever it is, you can't work well from home. The next one is HR. You don't have policies in place. People don't know what the issues are. They're afraid out of sight, out of mind. The next one is middle management resistance. We still live in a world where presence trumps performance for many people. How can I manage you if I can't see you? I have no idea what you're doing, but I see you, so I feel better about that. Until we get to a point where people are focused more on what you're producing than the fact that you're just there, this is probably not really going to take off. And the last reason is we're human. We are human. We're territorial. We're creatures of habit. We're social. People often ask, hey, why doesn't hoteling take off a lot more than than it did? I want you to think about it. Most of us can't sleep on the other side of the bed. You want me to sit at a different desk every day? Now, we're starting to get a little bit more mobile, but we are territorial. We stake out our territory, and we like to be there. So, how do we get people moving? Well, New York City did a pretty good job of coming up with the active design guidelines. Mayor Bloomberg commissioned these, and it talks about designing our cities and our buildings to be more walkable, to get people to walk to work, walk to lunch, build staircases so that people are using the stairwells more. But where this falls down is the second you get to your office and where you're going to spend the next 8 hours, all of a sudden the recommendations get real thin. And so we need to start thinking about it. One of the things that we're seeing a ton of today is clients asking for sit-to-stand workstations. This is a huge trend, and there's a good reason for it. If I said that you could make your workforce 66% more productive right away, would you do it? The answer should be hell yes, right? Because you got 70% of the people that are sleeping on the job right now, okay? So if you can do anything to get those people more engaged, it's going to be better for your company. Well, this numbers show of people that have gone from sitting all day to the ability to sit to stand, that 87% were more comfortable, more energized, 75% felt healthier, 71% were more focused, 66% felt more productive. Now, the naysayers in the audience are going to say, okay, they felt more productive. Were they really more productive? Okay, well, if you feel more productive, you're probably happier and more satisfied. And if even half those people actually were more productive, hell, I'll still take that. That's 33%. We've got to do anything and everything to get our workforce engaged, because we're spending a whole lot of money for people to be sitting around doing nothing today, and that's not good business. We need to start designing environments that respond to us, not the other way around. Crawling under your desk to get your power is not cognitive. It is not designed to be in sync with us. So we need to start thinking about designing our environments to be more responsive to us. Because the bottom line is, we're wasting a lot of money. How much money do you think each company is wasting per employee per year due to distractions? $10,000 an employee per year. That's a car. Okay, it's a shitty car, but that's a car, right? That's a lot of money. I would take that in my bonus pool any day of the week. And when you look at those numbers, 33% said they had difficulty producing, 25% said they had trouble getting to deep, meaningful thought, 21% they said they didn't get enough information or they had information overload. Now I'm going to pause there for a minute. Remember I said about statistics being made up or not being right? This one I'm going to argue with right now. Have you ever met anybody that says they don't get enough email? Like, I want to know, who are the 79% of the people out there that don't think they get enough crap every day? Who? I have never, ever met anybody that says, you know what, could you send me some more stuff because I don't get enough info every day. It's the exact opposite, right? We are overwhelmed, but studies show that if we can start designing environments to get people active, engaged, then absenteeism will drop. Asthma, depression, drop. Caterpillar did a study. The people that scored better on the well-being index repeatedly, over and over and over again, were their top performers. Happy, healthy, engaged, empowered workers will do more for you any day of the week than pissed off, disgruntled, unhappy, unhealthy workers. That's what we need to be talking about. We need to think about that. Because if we can improve well-being, we can reduce medical costs. We can increase and improve performance. And we can increase the economic value, let alone the happiness and the health of our employees. There's an economic value to this. If you don't like change, you're going to like irrelevance even less, because change is here. And we need to start thinking about doing things differently to get people more engaged. So going forward, we see we are on the rise of the human factor. We need to focus on getting people engaged. We need to get technology in check. We need to create balance between concentrative and collaborative spaces. We need to provide a variety of spaces that stimulate people and give them options and choice. We need to give people a higher degree of customization, allow them to move to improve their well-being. We need to allow them to engage, not only each other, but the work. Because today we are no longer just simply designing environments, it's about the entire experience. So with that, thank you very much.
Wasn't that good? That was great. Thank you very much, Kay. And a few housekeeping before you walk out that door. Hang on.
Hang on. As you go out the door, if you go out 3C over here, you'll see the Avison Young booth. If you'll drop a card in there, our client, Cronky Sports and Entertainment, has given us 3 pairs of fabulous tickets for Nuggets Avalanche. If a card's in there, at the afternoon break, right as you come back, we're going to draw for those tickets. So please, it's right out here. It's the first booth on your left. Boxed lunches are provided if you have the ticket with the orange square on it. Don't again forget to get your index card marked. Get your bingo card marked. And lastly, you don't have to, I should have probably told you this at the beginning, you do not have to write all this down. All of this information, the slides and presentations, you can pick up on rmexpoforecast.com. rmexpoforecast.com. And can we give Kay another big round of applause? Was she awesome? She's awesome. Thank you so much. See you after lunch in an hour.
better? I was on my leg for the most I've been on yesterday, like 10 hours, because I was here all day. The one thing I've heard though is they're not industrial strength, and I don't know that we've got separate boxes, which we should. Thank you guys very, very much.